Okay, so welcome to our webinar on managing your business back to the new normal. My name is Maggie Bolt with the Poirier Group. I am joined by David Poirier, the founder and CEO of the Poirier Group, as well as Amaris Sahota and Lisa Zhu, both senior consultants with us at the Poirier Group. So today we'll be taking you through a number of dynamic models to create risk-appropriate and sustainable measures to bring your business through the next phase of this pandemic. So before we begin, I'd like to thank the Association for Corporate Growth for being our promotional partner. We would also like to acknowledge the Financial Executives International Canada and the Institute for Industrial and Systems Engineering for their support. We have hosted previous webinars with IISE and ACG, the recordings of which are available on our website, which may provide additional context for some things that we'll be discussing today. Just some general housekeeping before we get started. This webinar will be recorded and a copy of it will be sent to you in an email tomorrow from me. There's a PDF version of this webinar available in the handout section in the bottom right drop-down menu of your screen. You can download it before the live webinar is over, or you can contact me after the webinar and I can send it to you. If you have any questions, please type them in the chat window and we will answer them at the end of the webinar as time permits. Any other questions, comments, or feedback can also be sent to us after this webinar as well. I'll now pass things off to David, who will kick us off.
Thank you, Maggie. Good morning, everyone, and thank you for visiting us and listening in on the webinar today. This is really third in a series of webinars about dealing with COVID-19 and its impact on your business. And we're going to focus a little more on forecasting and scenario planning today and how that fits into the overall challenges we have. So we're going to take a view of where we are today and then what the immediate current state looks like, and then look at the medium term for scenario planning and leading to a sustainable model. And we'll open up for questions at the end as well. This is one of my favorite quotes for the time that we're in. Haruki he's a famous Japanese author whose works have really been translated into over 50 languages. And I draw your attention to the second sentence in the first paragraph, where he says, "You won't even be sure whether the storm is really over." And I think we're all feeling that to a certain extent. And one thing for sure, when we do come out of the storm, we're not going to be the same person or the same organization that walked into the storm. We'll follow this notion of the pandemic being a storm for a moment. And you can see these 5 points. The first one is really, let's focus in on controlling what we can control and identifying areas that we cannot control and manage them as risks. We have to also look at the storm in stages or segments and take those segments separately and deal with them separately. And we'll be hearing a little more about that as well. And then as we approach the back end of the storm, we really want to make sure that we identify those threats and opportunities that we're facing so we can capture the opportunities, avoid the threats, and manage the risks appropriately for the business. The reality is we're going to be facing a lot more risks in our organizations than we ever have before. And as a result of that, we're not going to be able to deal with all of them and bring those risks down to zero. It's about managing those risks in a careful and thoughtful way that we optimize the balance between that risk management and the opportunities of growing our organization and making it successful sustainably. And the last point is really around adapting. And I want to bring in the notion of optionality versus optimality. For the last 20, 30 years, our organizations have really been focused on making things optimal, as efficient as we can in handling in the offices, in our supply chains, in our operations. And that has created some rigid organizations that have faced significant disruptions as a result of what we're in right now. And so we're going to talk a little more about optionality, making sure that we have a number of scenarios available for us so we can pivot quickly to those opportunities that we're facing, and also pivot to avoid those threats that we see emerging coming forward. The next slide really talks about disruption, and it's not new to our organizations to face disruptions. And disruptions have been happening for a long time. Just think about the taxi industry and what Lyft and Uber have done to them. But what's really different is the new breadth and depth of the disruption that we're facing, not only us, but competitors and the environment, our customers, our suppliers. And the real keys to moving forward are around innovation, awareness, and speed of change. And so we're going to focus in on those so that we don't end up in that bottom left corner with RIP written on our organization. And so the way to achieve this is really shown on the next slide. And although it's a fairly complex slide, I want to really talk about things in a very simplistic way. It's about building understanding, integrity, and alignment and commitment through your organization, which will lead to speed and trust, the ability to move the organization quickly, to pivot quickly together. And organizations on the right-hand side, under the heading at effect, are in a difficult situation. If they haven't been already, they certainly will be. And this notion of being at effect is really a victim mentality or a fatalist mentality, where it's not my job, things are going to happen, we cannot control the future. And we really have to drive our entire workforce over to the right-hand side, which is being at cause. That is being accountable. And we do that through a number of particular aspects of changing the organization, transforming it. So focus on strategy and policy, rapid deployment on visual measurement management systems, and the other three as well. Communication is critical, measurement's critical, and alignment is critical. And we want to make sure that we have alignment and attunement of the organization. Attunement being the areas within your organization clearly connected through communication, through measurement and accountability, and focus in on those areas being aligned. And the notion I want to bring forward for you that I've spoken about before is the notion of a disciplined organization. And by discipline, I don't mean rigid. If you think about a great sports team, the reason why they've been successful is because they're disciplined. And they're not rigid. If they were rigid, they'd be predictable and they'd be beatable. But they're disciplined and they're synchronized in their efforts and approaches, and they're ready to take on new scenarios at all times. And that's where we have to get our organizations to really be successful sustainably for the next period of time. The next slide talks about the 4 different types of organizations that we have. The Phoenix, essentially that's a business that came into the situation somewhat weakened already. And essentially, life is going to be over for them, and they'll have to reinvent themselves in a new manner. The second group are the group that have to retrench, that is hibernate right now, preserve assets, do what they can to prepare themselves for when this is over so they can reemerge. Examples of this are cruise lines, Disney, organizations like that, movie theaters that have had to essentially shut down their business, preserve assets as best they can, and ride out the storm. The third group are the ones that are adapting, so still looking for revenue to come in, making changes to their business, and pivoting. And examples of this are ventilators being made at auto manufacturers, curbside pickup for retailers and restaurants, where they have done what they can to manage the top line, maintain their customer base and the loyalty associated with it, and stay in business. The fourth group, Thrive, everybody wants to be in, but they're facing a challenge as well. These are organizations that have gone through significant or dramatic growth. Zoom is an example, Zoom video, and it's gone through enormous growth. Walmart's another one that's gone through significant growth. But the growth of those organizations, along with Amazon, has not been all that easy. It's been great for their top line, but not necessarily great for their bottom line. If you think about organizations like Walmart and general merchandisers that have been able to pivot and go online and sell groceries at the same time, groceries and online business are the least profitable aspects of their businesses. And so switching to there and having dramatic improvement in those areas, but not keeping up with their general merchandise that they tend to make a higher gross margin on, has hurt the bottom line of the organization relative to what it could be. And so those organizations that are in Thrive have to figure out how can they maintain the growth that they've achieved and yet still drive the bottom line in a way that is meaningful to their shareholders and to their customers. And that's a real challenge. And so going from the chaos that they've been facing in the growth that they've gone through to a measured, managed way that can sustain that kind of growth over the long term. So your organization will fit into one of these four models, if not a bridge one or two of the models. Three of these models really require forecasting and scenario planning. And so now what I'd like to do is turn the microphone over to Lisa Hsu, who will be taking you through understanding your current state and forecasting. Okay, Lisa.
Okay, thank you very much, David. Well, so when we are talking about going back to normal, the first thing that we typically would do in a business planning process is we need to establish your baseline. So we still need to look back into your pre-crisis as your baseline, but please keep in mind that as we always are seeing that the things might change after the disruption and the crisis. Your customers, your competitors, your supply chain, they may all have some sort of a change after this pandemic. So keep in mind that, and we will cover the scenario planning methodology in later today's webinar. But first, let's keep looking at how we can make it through to the other side of this tunnel. And the question that we really want to ask was, including what's your strengths and weakness, what are you doing better than your competitors, and what did you do not as good as your competitors? And who are your customers? What do they want, and what's their behavior look like before the crisis happened, and what is going to expect to change after the crisis? And thinking of your supply chain, are they from domestic or from overseas? And what kind of a challenge that they may be facing? And most importantly, are they adaptive to your new requests? And in this situation, particularly when we talk about sitting on your feet right now, is going through the financial positions assessment and seeing a list of a metric that we're going to talk about in today's webinar, which is commonly used and highly effective indicator that can tell you how your company is ability to repay the debts. And your inventory is also important aspect to looking into is if there are easy to convert into a cash, or which inventory are you stocking up as a overstocked, and have you understocked with the other aspect. So the next is looking into your organization. Is that flexible enough to adapt to the new change? And as well as your people, what was the team morale before the crisis, and how are they doing right now? With these questions in mind, let's move on to the next slide. And we would like to recommend using a dynamic forecasting model to help you to manage these changes. And this is a two-way interaction between you and your stakeholders, and it will give you the capability to forecast the future state in a dynamic way, which means in one situation may change, and you will be able to adjust your actions and quickly reforecast your future states. And now let's look at each bucket and discuss how it works. When you talk to your creditors and investors, for some scenario that companies in the strive and adapt scenarios, there are many opportunities showing up, but it may not be as profitable as at this moment, as David has mentioned, the retail groceries, they're expanding their online shopping capability right now, but it's a large investment to be able to conduct it within a short period of time. Usually takes years for business to do it. But how can you convince your investors that this investment will still give you a long-term return after the crisis? When the pandemic is over, it will still be a new trend that you will be able to capture and you'll make it profitable. And in other scenarios like the retrench and Phoenix, the conversation will be focusing on how to arrange a temporary business loan and short-term cash injection to help you to get through this crisis. And secondly, the government support is also a dynamic input. There are measures and new policies coming up every day, and every day counts. You don't want to waste any time to gather information needed for applying for this support. And if there's a new policy and supports coming up with a dynamic forecasting, it will be easily to see your future states with those impacts coming in, so you can adjust your course of actions. And the next, talking to your supplier and vendors is also a dynamic interaction. For the company that in the strive and adapt scenarios, you want your shipment to be faster. In other cases, you may want your shipment to be slower. It is always a good idea to proactively talking to your supplier instead of waiting for them to inform their decisions. And lastly, talk to your employees. Your employees need transparent information, and you need to bring people together. There's no one-size-fits-all solution here, but whatever you're planning to do, you want your team to onboard with you. With all of these key stakeholders interaction, you'll be able to build a dynamic forecasting model so that you can adapt yourself to different situations. When some conditions change, you can quickly reforecast your future state. And at this moment, we recommend to do a weekly financial model instead of a monthly or quarterly like what we used to do in the normal time. And you need to be prepared for several assumptions on different shutdown period, like 3 months, 6 months, or even longer in some cases. And most importantly, you need to focus your attention on the most worst scenario, because that's the plan that you're going to put ahead in preventing, taking actions to prevent the worst case happening. So the next slide is an overview of objective for the financial statement analysis. Using the financial metrics, we can gain insights on the current and the future status of the company, when whether it's in your performance metrics and how flexible your financial situation is, and give you a relevant trend to see in the future. And particularly in this setting up the stage to get through the pandemic, the KPI is really important for you to keep an eye on and keep your business viable. And next, we will need to go a little bit detailed to the tactical level to look at some of the key financial ratios that we want to discuss today. They are helpful to maintain your short-term financial stability. Our goal here is not to show you how to do the calculation, but rather we want to demonstrate how to use the financial metrics to guide you through the crisis and inform your business strategies. We have prepared a very simple company's balance sheet for illustration. And here we show you the liquidity ratios and the solvency ratios. If you can go back to the previous slides. Thank you. And the liquidity ratio is really can tell you how fast a company can convert your asset into cash so that you can meet your short-term obligations. And we're showing here our current ratio and the quick ratio. The difference between these two are really the current ratio taking consideration of all your current assets. But in some situation, like a company in shutdown mode or in a retrench scenario, they will not be able to convert their inventory into cash that quickly. So the quick ratio is taking out of the inventory out of the equation so that you can see what's the really a quick cash that you can have to cover your current liabilities. So as you see, this company, it shows it has $2.5 of current asset for every dollar of the current liability. And it's a quick ratio points to $1.6 to the quick current liability. As a summarize, the company has a comfortable liquidity position. But if you move to the next slide, that we show you in a dynamic forecasting model, you'll be able to put this cash and marketable securities, your account receivable become a variable input. Because during the time, as time changing week after week, your account receivable may not be as is in the sitting right now. It may have some bad debts showing up. And so with a dynamic forecasting week by week, you'll be able to see when your ratio is dipping into a dangerous point. As you can see here in this company, in week 6, it will go into a very dangerous position so that you can prepare yourself to taking action before it happens. Okay, and so the next important aspect to look at a company overall financial healthiness is the solvency ratio. So as we said, if you have, as long as the company is a solvency, you can still arrange some sort of a loans to cover your current ratio. But in this company that we are showing, it started with 2/3 of the asset has been financed. So it's already started with a very dangerous position. So the rule of thumb is to keep an eye on those ratios and making sure you have enough total assets to cover your total liability. And to be able to be liquided, you need to have your total current assets to cover your current liability. And at the bottom of this slide, we are showing some other ratios that we commonly use to keep in companies watching the efficiency is the activity ratios, which tells how efficient the companies perform day-to-day tasks. What the list is the days that turn around your working capital, your inventory, and the sales. And the other side is the profitability ratio that we commonly see is the gross margin and net profit. So next, I'm going to turn the stage back to David to move on to the next topic.
Thank you, Lisa. I appreciate that. So let's look at where you are currently, and some of you may be struggling with cash flow for the organization. We want to take a step up now and look a little bit more strategically at the future and how we can adapt our organizations to increase the slope of the recovery curve as we come out of this situation. And I'm going to turn it over to Amaris to take us through that.
Great, thanks Lisa, thanks David. And we're going to shift gears, as David said, now to really move the focus from taking your business from this survival mode and prepping for having a cash view on things to really going into how to revive your business to be prepared for the new normal. I'm sure all of us have seen there's so much information that's being published every single day about the pandemic, new statistics, new buzzwords coming out, and it ends up leaving us with a lot of lingering questions and sometimes not a lot of answers to go behind them. So that's really our big question that we're going to focus on through this. How do you take all of this information and really use it to prepare for the future? And as we go into the next section, one of the things that we'll find is that doing nothing and being paralyzed in survival mode is one of the most detrimental things for your business. I hope I'm not alone in saying that I personally hope toilet paper will not be the hottest commodity in 2020 when we look at what a new prepared for the future will be like. And so by focusing only on the survival mode, it really cripples our ability to proactively stay ahead of what's to come and brainstorm through the challenges, look at our assumptions, think about the implications, and map out those alternative strategies and solutions. And now is the time really to proactively shift gears, as the decisions you make today will really define your ability to thrive in the future and move out of this crisis mode. And in order to do that, the future really starts with putting together a plan ahead team. If you were able to join some of our previous webinars, you've probably heard us talk about this concept discussed really from the notion of a crisis response team who's responsible and their focus is on that short-term crisis management. They support all the decisions that Lisa just walked through and everything that goes along with that crisis self-assessment. The plan ahead team is a small team, but a nimble team with diverse perspectives. You want to be able to leverage both internal resources across the different functional areas like HR, operations, finance, as well as external insights that come along. The group should really meet daily, and their focus is supporting executives through quick decision making. In these uncertain times, the goal of the team is not necessarily to lay out this long-term plan with 100% precision. Rather, the focus should be more on questioning the assumptions, reviewing and refining scenarios, and thinking about the strategy over time. You want them to be able to take these deliberate next steps that align with your customers and your employees as both being very key stakeholders as you move into your new normal. As part of that, unlike your typical strategic plan where you'll look at a 1 year, a 3 year, a 5 year, you'll have to go more granular, so the timeline is going to change. In these uncertain times, you really need that ability to be flexible and to pivot. David mentioned right at the beginning that idea of optionality. That's what you need to build into your timelines and build into your scenarios. And you do this by really breaking it down into these manageable phases. Instead of looking at long time periods and big blocks at a time, we need to start thinking about what do we know right now? And that's really what we know has a high likelihood to happen. And then what's really the next 2 weeks? What's the next month? What's the next quarter? All the way to hit that phase of what's the next normal. And so in order to do this, you start with the what is. So with that, the crisis poses a lot of challenges, but it's also this unique opportunity for you to take a step back and reflect on what have you learned from your strengths and weaknesses of your business model that have come to light from crises like COVID-19, and take those learnings to prepare for the next phase. And so there's going to be some businesses that have downside risks that need to be mitigated. If you think back to that page right at the beginning where David showed the 4 disruptors that each business will really fit into or overlap in some way, the ones that really have the downside risk to need to mitigate really come to light for those retrenched businesses. For others, they may have identified upside, but the question is the sustainability of those opportunities. And that would have come to light for those who fit within those adapt and thrive buckets. And so really these learnings become your way of thinking through what's my current strategic plan of where I thought I was going to be, and how might that change as I look to what the next normal will be, and how can I make sure I'm in a place where I really successfully can absorb any future shocks, because like we said, we don't know, we could be going through a wave right now where it looks like it's getting better and just be hit by another wave of this later, and you're trying to set up your business at this point in time to make sure that you can absorb those shocks in the future. A critical part of the what is the financial statement analysis piece. I know we touched on this really at a tactical level when Lisa walked into some of the ratios you should be looking at. When we look at the future and we look at what we should focus on, the questions we ask ourselves around these same 4 buckets varies. And really from a financial flexibility perspective, you're thinking, well, do you have that liquidity and balance sheet strength? But also, how can you continue to invest in your company to move out of the crisis while also meeting your debt obligations? From a trend perspective, it goes beyond what's the long-term trend, but also how is it going to change? How have business boundaries been redrawn? How has consumer behavior shifted because of this crisis? And then from a company KPI perspective, looking at, is my business model actually resilient enough in the way it's set up right now? And also, how do I have to go about revising my target to be more realistic for what the environment is today? So understanding that base of your financials and of your current state strengths, that really lays the foundation for going into this next section, which is really all about assumption testing, dynamic scenario planning, and forecasting. So we can start with assumption testing. This really is the beginning of what if, and what does that future look like? I know many businesses really were forced very quickly to shift overnight, and we couldn't predict this was happening. No one knew that it would be impacting businesses to the degree that it has, but we do have the control right now to start thinking through these assumptions for what that next phase looks like and understand how these various factors influence that outcome. A lot of these you would recognize from how Lisa walked through when you're looking in your current either pre-crisis or during the survival mode. And now you'll see how the thinking shifts going forward as you look at the future to really get that good gauge of how well your business is positioned. In this, you really need to account for what could happen, what's likely to happen, and what you actually want to happen. And so with each of these, you're asking questions from consumers. Have their habits shifted dramatically? How is reopening going to impact demand? Do you have pent-up demand in your business? Have you been in a Thrive environment where you have exceptional demand right now, and is that sustainable going forward? To suppliers where you're understanding their resilience, or have you had to reshape your business to create new partnerships along the way? Creditors, if exactly what we were saying before, understanding what your financial flexibility is, but also creditors' strength to be able to offer you continual financing going forward. Competitors, of understanding where you are versus them. Government intervention, as Lisa noted, policies are changing all the time. And employees, which is a very important factor of understanding what does it look like? Do people work best remotely, or do they work best on premise? You may have had to make restructuring changes as a result of the pandemic. So are you now over or understaffed to be able to meet your plan going forward? And how do you reach back to that optimal phase? And then have you maybe found this improved operating cadence? And is it sustainable for the well-being of employees? So there's multiple assumptions that you'll have to consider, and with each one of those, the likelihood of that assumption actually occurring, but also the impact if you were wrong. And that will define your flexibility to really be able to pivot if you go down that route. So these assumptions create that backbone to really help you envision then multiple futures post-crisis. So that gets us into dynamic scenario planning. So with dynamic scenario planning, it really takes all our assumptions and it says, okay, what do we actually do with these? What's our plan going forward? So right now we operate in a VUCA world where the norm for us feels like it's been volatile. It's frequently changing. We have to adapt to the new very quickly. It's uncertain, where we don't know what each day is going to bring. It's complex because there's so many unknown factors, and it's ambiguous because at the end of the day, we haven't had a precedent that we can look back to and say, this happened in this event, this is likely to happen in the future. This is entering new territory for us to be able to have a strong prediction of what it looks like. Because of that kind of environment, we really have to depend on dynamic scenario planning, where we're creating multiple storylines around multiple potential futures to really build in that optionality going forward. The biggest piece is not to get caught in that vicious cycle of really building a rigid plan, and that goes into what we were talking about. You may have built an optimal business that has this rigid plan that's around it, but if we stick to that in this kind of volatile environment, it's going to cause you to have to race to make cost cuts. Maybe that means laying off employees, postponing large projects, or having to secure financing that you weren't expecting to do. And so that's where it brings in the OODA loop. And this model really comes in to allow you to observe and track what's going on in the environment, orient yourself to make strategic assumptions around those new observations, decide and make the quick decisions that need to happen at this point in time, and act. And it's really this endless cycle that will keep going back, because we have to understand that the variables right now are more dynamic, and our ability to be able to pivot very quickly in our scenarios is key to surviving the volatility. The big goal of scenario planning is different from how we may have looked at it in the past, where we gain strong confidence that this is the route and this is the assumption we want to go. Right now in dynamic scenario planning, it's not about improving that level of confidence. It's about creating profitable and executable plans that really have all these different potential futures attached to them. And instead of pivoting just around the known factors, we pivot around the known plus the uncertainty, so that you can plan for, you can account for, you can prepare for the uncertainty and the risk as we move beyond the crisis. And that's where the plan ahead team really comes in, because by following this, where they're constantly observing, reorienting themselves, making decisions off of that, they're anticipating these shifts, and they're reviewing and revising the scenarios based on changing market assumptions, monitoring the real-time indicators of what are consumer expectations, what does my supply chain look like, what's my talent pool, and taking all of those pieces that we saw within the assumption canvas. And so really, if we look at the process of what dynamic scenario planning is, it's starting with a focal issue. It's not going to be the same for everyone. Even businesses within the same industry will have a different focal issue based on what your what is analysis piece and what your current state looks like in this moment. From there, you're really looking at the key factors relevant to your business, as well as the external forces. And these will draw back from the assumptions that you just created on consumers, suppliers, government intervention. Are we on lockdown? Are there restrictions on sales? Is there an economic shock that's happening? I'm really going through each of those to be able to create the logic behind your thinking of what's the focal issue. Your critical uncertainties and risks identify all the unknowns that you have to consider around your scenario. And like within the assumption canvas, what's the likelihood that those occur, and what's the detriment if they are going to occur? And that really helps form the logic for your story. And that story goes into thinking about, how will this scenario actually play out? It goes back to the big two pieces of, is this going to be profitable, and is this actually going to be executable? Executable being a very key part of it, because it can be easy to say, here's my ideal state and here's where the bottom line is the highest. But in this kind of environment, can you actually execute this plan going forward? And from there, it really takes us to the implications and options. That piece is, what happens if my scenario occurs? Knowing that that trajectory is uncertain, how easily can you pivot from that alternative? If it happens, can you move in a different direction? To then your early indicators, which are, when you see them, you know when that's when you need to make rapid and decisive actions to change your model. Just as a quick overview on the next slide, you'll see us putting it in action. You'll have so many key factors, so many external factors as well. But if we just take a quick example of thinking through the future of learning, a key factor that will go in is consumer shift. From there, external forces are around the government right now mandating school closures. And the uncertainty would be, is there going to be investment then in educational technology going forward to support the consumer shift? And taking that logic and seeing, how does your scenario play out going forward? One of the key risks that the plan ahead team and the executives really have to be careful is not to get caught in the behavioral biases that come along with scenario planning. And so that can be the availability bias and making sure that you don't just use information that's right there. One of the most important ones to touch on is the action bias, that feeling that I have to do something, even if I don't know what it is that I should be doing. And so you favor just doing something, actually overdoing the analysis. And that's where going through these steps of, let me think through what's my current state and where do I want to be going? What's my assumptions that I'm making? Let me actually plan out those scenarios. And then what we'll get to in just a moment is actually forecasting out those scenarios helps stop you from falling into that action bias trap. The others that I'm sure you're very familiar with, bandwagon bias tends to be groupthink, excessive optimism that Lisa talked about, where you actually have to take your most unfavorable outcome versus just opting to go for the favorable ones and see how that looks. And then projection bias, we're not really in a place where you can just take past preferences and project them forward to current. And on that note, it takes us to, what does forecasting look like? It's really the final stage in the process. And traditional forecasting, you tend to use predicting the future, which really relies on past data. In a pandemic environment, the future is quite unknown. And so traditional forecasting is not very well suited to keep up with dynamic changing market conditions. Therefore, you switch that from traditional forecasting to dynamic forecasting, where you're really having that backward-looking and forward-looking factors. And so backward-looking data pre-crisis, and where does that lead? Forward-looking, what are the shifts and signals that we've seen of changes in the environment, and how does that then project into our forecast? Really, one of the big takeaways is, despite where you are and disruptions impact all of us differently, whether you've been in that survival retrench mode where you've really plateaued, or pivoting your core business to adapt, where you may have gone down at the beginning and now been rising because you've changed your business model or experienced rapid growth through Thrive. Our recovery will not be linear going out of this. And the changing environment requires speed and decision making. Companies can't just sit there and wait to recapture the revenue, because competitors are thinking out, they're planning through these assumptions, their scenarios, their forecasting to make sure that they're in a position where they can really protect their business and recover stronger as they move into the new normal. And with that, I will pass it back to David.
Great, thanks very much, Amaris. I want to talk to you about the 5 words that I think are absolutely critical to moving ahead, no matter what scenario you're in right now. And the reason why we have to focus on these 5 words is we are going to have to dramatically increase the pace at which our organization is able to move, adapt, and capture opportunities going forward. And so these 5 words, communication, alignment, visibility, accountability, and discipline, are really the key elements to driving the speed of trust within your organization, which provides you with the ability to progress and pivot more quickly. And that's really the key. And there are going to be a lot of changing things. You know, one of the interesting facts that I've come across recently is it takes 21 days to change a habit. Many of us have changed habits over the last 7 weeks. Another interesting statistic is it takes 66 days for that habit to become automatic and permanent. And so we're starting to face permanent changes in the way consumers and employees are behaving. And we have to adapt our businesses to those things. So these key elements of communication, alignment, visibility, accountability, and discipline are critical to building that optionality versus optimality for our organization, and focusing on what we can achieve using the tools that both Lisa and Amaris have spoken about. And we found that our clients have embraced these changes very well and increased the pace at which they're looking at their businesses, reforecasting their businesses, and capturing those opportunities. I want to share with you now very quickly some key points to consider in returning to the new normal, whatever that may be. Of course, the first one, you have to preserve and grow the top line to the best of your ability. Build trust with your clients or customers. Make sure that those lines of communication are open. Revise your financial plans and make sure that you're instilling dynamic scenario planning and stress tests associated with it. Focus on speed and agility, on moving faster as a group, aligned with an aligned and attuned organization, and monitor the responses to the market. You keep an eye on what the government is doing, where their spending is, how that's going to affect your organization, your clients, or clients' organizations, or your consumers or customers, as well as your suppliers, because these changes are happening very quickly. Then you've got to adapt those current resources to meet those changing needs. Maintain rigorous cost control, but that doesn't mean rigid cost control, but rigorous cost control. Make sure that it's disciplined, but your procurement processes are agile. The old method of bureaucratic procurement processes will not work in the new world. We have to be a lot more adaptive and create a lot more optionality in our supply chains than we've ever had in the past. And make sure that we emphasize and demonstrate your core values. So walk the talk. Make sure that you're building trust with all of your stakeholders, with your employees, with your customers, with your suppliers, and with your shareholders or investors and bankers. It's critical that those 5 words come into play with all of those individuals, and that you stand for your core values, so that in the end, trust is what's going to drive performance for your organization and make you stand out amongst your peers and your competitors. That'll provide you with opportunities as well coming out of this if you create a steep enough recovery curve to be able to take advantage of that and potentially do some acquisitions. I want to thank you for listening to us today, and I'm going to turn it back to Maggie now for questions and answers.
Well, thank you, David, and thank you, Amaris and Lisa, for that great presentation. So before we get into questions, I'd like to thank everyone for attending. In the next couple weeks, we'll be developing additional webinars to address the next stages in the recovery period, including accelerating the path to the new normal and how to manage these increased risks. So stay tuned for more information. So once again, I'd like to invite anybody with questions to type them into the chat window on the bottom right, and we will answer them accordingly. We have a couple here to get us started. So the first one I'll direct to Lisa. What is a safe range for your liquidity ratio?
Yeah, of course. So normally we're looking into about 3 times to 6 times. But in this pandemic, things are really unpredictable. You really need to take consideration into a dynamic input, because your current asset may not be worth the same as when you're getting into the next week. So really, it's a dynamic range. And again, for a different industry, the ratio is looking very differently. As a company like a consultant and versus a company that in a manufacturing, it's a totally different picture that we are looking at. You should really do a internal benchmark versus an external benchmark to give you a better insight of where you're comfortable with. Okay.
Great, thank you. Another one, I'll direct this one to Amaris. What are the top 3 things that I can prioritize coming out of this pandemic that my team and I need to do or to set up? Or if anybody else wants to answer this as well.
Yeah, definitely. Sorry, I was muted, just unmuting quickly. It really starts with making sure that you have that plan ahead team in place. I'd say that's the first thing, to make sure that you really have a team that's dedicated. Making quick decisions are so critical during this time, where you're not waiting to go through all the red tape or having bottlenecks. It's a dedicated team. So I would say that that's number 1. Number 2 is exactly what David was just talking about, where align with your core values. You don't want to take this time and completely change what your business is all about. You have trusted customers and trusted employees, and really keep them in mind. And the third one I would say is really don't be static. It's important to really forecast as many different potentials as possible, whether that's best case or worst case, and know what they look like and know your flexibility to move from them. You don't want to be stuck in going in one direction and then you've committed down a path, but new information comes along and you can't move away from it.
Thank you. And then again, I might direct this one to you as well, Amaris. What ratios should we be looking at right now to assess our profitability?
So I believe Lisa had a few on her slide as well when it came to profitability and looking at things like your net profit and your gross profit and really assessing those. Those are core profitability ratios from a net income to revenue. So your net profit margin, it will help tell you what's my future profitability. You want a high ratio. At the end of the day, a larger proportion of your dollar revenue will be turned into profit that way. Your gross profit really lets you know that bare minimum of can I cover my operating expenses. And so when you're trying to shift that focus from just looking at cash in survival mode and looking to profitability, those are two core ratios to look at: your gross profit margin of can I cover my operating expenses, and your net profit margin of what's my potential future profitability.
Yeah, I agree with Amaris. And also keep in mind that every company's P&L is looking very differently. If you just look at operating incomes, you could have a lot of a fixed expense that's building into it. If you look at it in a dynamic way, you really need to separate your fixed expenses versus your variable to be able really to tell how flexible you are. That's my one point.
Great, thank you so much. And if there's no other questions that are coming through right now, we'll wrap it up and give everyone an extra couple minutes back. Thank you again, everyone, for attending. Our contact information is there. If you have any other additional questions or feedback, you can email me at the email there. Also, for additional webinars and news and any other handouts coming up, you can follow us on social media at the Poirier Group, and let me know if you have any other questions coming out of this. And with that, we'll wrap up. Thanks so much, everyone.